Well, good afternoon, everyone, and welcome to today for our Third Link Growth Funds webinar. My name is Nina Dunn, and I'll be moderating our discussion today. It's great to see so many of you joining us for this webinar. I think we've got about over 100 attendees, so that's fantastic. So thank you for joining us. We're going to be taking a closer look at the Third Link Growth Fund and hear from two of our underlying investment managers, along with some key insights and takeaways from the Australian reporting season. For those of us who have just joined and don't know too much about Third Link, we're an Australian equities fund of fund with a unique social impact-driven model, whereby all of our underlying managers rebate their management and performance fees, and the fund then donates its management fee post-expenses to our nominated charities. Over the past 16 years, we've not only generated some strong investment returns for our investors, but thanks to the generosity of our underlying fund managers who rebate their fees, we've been able to donate more than $22.5 million to our Third Link charities, which is fantastic. So we've got a great lineup today. First, we'll hear from Chris Cuffe, who founded Third Link, and will share his insights into the origins, his manager selection process, and performance today. Following that, we'll hear from two of our investment managers. We've got Chris Stott from 1851 Capital. Thank you for joining us, Chris. And Tim Carlton from OzCap Asset Management. So we're going to hear more about their funds. We'll gain some perspectives on what's been happening in the market and an overview of the recent Australian reporting season. We'll then open up the floor to Q&A, so please feel free to submit any questions you have throughout the session and we'll get to them at the end. So with that, let me introduce Chris Cuffe so he can give a bit of an intro onto the fund.
Thanks, Nina. Well, I'm Chris Cuffe, as Nina said. I've been managing this. I set this fund up and have been managing it for nearly 16 years, so it's been going a while. It's about $170 million in size. And as Nina said, it's given away just over $22 million to charity. But more importantly, from my perspective, it's an Australian equity fund, a fund of funds, which I'll talk more about in a second. But it is one of the few funds in the market that, since it's been invested in Australian equities, has actually beaten the index after fees. So that's for around 13 years now. And most funds in Australia, in fact, across the world, find it very difficult to beat their indexes after fees over long periods of time. So the importance of that to me is I've always treated this as a very important investment in its own right. That's first and foremost. Secondly, the fact that it has a social aspect, giving to charity, I think is really the icing on the cake. But I like to think of it as a very solid investment. In fact, just looking at returns since it's been an Australian equity fund from February 2012, it's returned just almost 10.3% per annum compound, which has been great. And there are a few funds in the Australian marketplace these days that help out charities. Most of those are listed. This is a little unusual that it's unlisted, but I think it's actually a pretty positive feature because it doesn't have to deal with the ebbs and flows of discounts that often plague listed vehicles, particularly if people are trying to trade volume as well. So it's an unlisted fund, valued monthly. It's a retail product, so people can invest with as little as $20,000. I think our largest investor is over 10 million in, so it suits all types, but it's a very legitimate Australian investment. And the types of charities that have given to over time, it's been a whole variety. The website lists every single charity that we've given to in time, but it's tended to have a focus in the past more on charities that are assisting kids, kids being anyone up to sort of 18 to 20 type of thing. More recently, it's starting to broaden a little bit too now to help other charities where I think the charities themselves are making a real impact. And by the way, I also, with another hat on, chair a philanthropic organisation called Australian Philanthropic Services, who have a professional grant-making division. So I make sure anybody money is given to really has the rule run over them first to make sure they're very worthy. So that's pretty much where things are. The fund is rated. I only ever wanted one rating, just one group to have a look at it to legitimise it. It has a recommended rating from the Zenith group, which that's a strong rating. You can read about that on the website too if need be. And that's pretty much it. Oh, sorry. No, it's not pretty much it. Manager selection process. I should add a bit more there. So you'll see on your screen now, there's 12 managers that we're currently in the fund. And really the selection process, it comes from the school of experience. I've been in the investment management industry for nearly 35 years. I continue to serve on multiple investment committees of different size organisations and sit on multiple investment boards as well. So I'm very, very familiar with the Australian equities market and the managers that work within that. So I look for managers who I think can really add alpha in their process. There's a lot of managers in Australia. There's plenty of managers that try to beat a market industry, but find it very difficult. So I search for managers who I really think can. Most of them tend to be managers with performance fees, smaller organisations, not the big money gatherers, smaller organisations. And I also always say to anybody, if you want to invest in these 12 managers yourself, and they're all listed on the website, including the funds of theirs that we're invested in, you could invest in those 12 and you will not do as well as this fund. And simply because of the generosity of the underlying fund managers who waive their performance fees. And that's the real difference. So I've always thought this fund gets a sort of a leg up. If the managers are doing well, my fund should do even better because of the lower fee impost. But all of the managers I know well. I could ring them up any day. Very good relationship, and it's really my years of experience where I've landed on this group. I do slight changes from year to year, but it's really been a strong core for many years. So on that note, I think I'm handing over to
Great, thank you.
Chris.
That's great. So next I'd love to introduce Chris Stott. He's the founder and chief investment officer of 1851 Capital. And it'd be great. Oh, sorry. Just thought I'd actually note that the fund, you've just recently passed your 5-year inception. So that's congratulations for your Emerging Companies Fund. Chris has an extensive background in small cap investing and is going to share some insights into his fund, its performance over the past 5 years, and some key takeaways from the recent Australian reporting season. Chris, over to you.
Thanks very much, Nina, and thanks very much to Chris and to Nina for being included in the third leg product. It's a privilege and certainly a really terrific structure, which is very supportive of the various charities over time. So congratulations to Chris and the team. Delighted to be here today. In terms of us, 1851 Capital, as Nina said, we launched the business around just over 5 years ago now. So I run the fund with fellow portfolio manager Martin Hickson. We're a small cap specialist, Australian equities, a small cap specialist, running funds under management of just over $500 million. We soft closed our product to new investors in August of 2021 in order to preserve performance. We're of the strong belief, as sort of Chris intimated to before, we're of the strong belief that the smaller and agile you are in terms of size, and particularly in small caps in Australia, the better chance you've got to deliver superior returns. So you can see there on our returns are there on the slide, over the 5 years and since inception.
And then you've had some fabulous performance over those 5 years. So congratulations to you, Chris, and the team. Can you walk us through some of what were some key contributors to your performance during this time?
Thanks, Nina. Look, we've had some good contributors and some bad ones. So I can talk about the bad ones if you like, but I'm happy to talk about the good ones as well. Look, companies like Unity Wireless in the early days were really strong contributors for us in the telecommunications space. We've still owned shareholders in Pinnacle Group, which has had a tremendous run in the last 3 to 5 years. They've really done a great job in terms of diversifying the business away from being overweight to the equities side of things, equity sector, like they were for the previous decade. We still own Pinnacle today. Tuas, which is another telecommunications business, primarily based out of Asia, run by David Teo, who you remember is the founder of TPG Telecom, which we were a successful investor in TPG going back over the last 10 or 20 years. And so I like to call Tuas, or TUA is the ticker, as TPG Mark II. And more recently, a good contributor for us has been Generation Life, GDG, which are in the investment bond space, and have more recently diversified into the managed account space via an acquisition of Lonsec and Evidentia, run by ex-Olympian Graham Hackett, who is a terrific leader of that business and one of the most motivated CEOs I've ever met in my almost 20 years of doing this job.
So we've just finished February reporting season, which was probably one of the most volatile, I think, that I can remember. But what were some of the standout themes or surprises from this recent reporting season in the small cap space?
You hit the nail on the head there, Nina. It's certainly one of the most volatile reporting seasons we can remember for a very long time. And as an example on the chart here, Integral Diagnostics. It's a small cap that we luckily didn't own, but we have been buying recently after the result. It's in the radiology space. They came out with a result which missed expectations by 3 or 4%, only to see the share price down 35% on the day. Which is extraordinary. And then it actually rallied during the afternoon and only closed down 12. So just the moves we've seen in response to results are as vicious as we've ever seen, a function of various factors. So that would be one key theme that I would call out, probably the most volatile reporting season I can remember for over 10 years. Secondly, in the small cap space, we've met with over 100 companies in the last 4 to 5 weeks. So I'd call out one particular theme is that the cost growth. You're still seeing inflation hanging around in a lot of cost bases, and so margins, as a generalisation, were weaker than expectations. Various pressures, particularly on the labour or wages side of things, in particular with mining services companies out in the west. But generally speaking, the economy is holding up a lot better than you think. Retailers generally reported solid results. The cyclical companies generally did okay and certainly were generally ahead of expectations that were very low coming into it.
Great. So off the back of that, what other sectors or companies are looking quite interesting right now?
Yeah, I mean, we're sector agnostic. We're just bottom-up stock pickers, index unaware, as I should have mentioned at the outset. But some of our key holdings right now, Generation Life is our top holding. We continue to like that one going forward. We've taken some new positions in the portfolio, more recently Fletcher Building. We think they've turned the corner in terms of trying to clean up the various historical issues they've had in that business. They're working their way through that with a new management team and a new board. And New Zealand's slowly coming out of a really deep recession. I think as Australians, we don't realise how severe the recession was across the ditch over the last 12 to 18 months. So I think Fletcher Building's a really good exposure to the New Zealand macroeconomic recovery over the next 18 to 24 months. And also Collins Foods. So they own a range of KFC franchises, primarily here in Australia, in Queensland and Western Australia. The stock's halved off its highs over the last year or so. We think that there's certainly, when you look at the data points out from Restaurant Brands New Zealand and Yum, the parent company out of the US, the data points have certainly point to the more favourable conditions for them here domestically. Also with the new leadership team undergoing a strategic review of the business as you normally do as a new CEO into the business. Xavier has just taken over the role, ex-Kathmandu on the good days. So we're awaiting some of those things to play out for Collins Foods over the next 12 months. So we think that Collins certainly looking at in a really good position right now.
Okay, that's good news. And for a sector that can be quite volatile in the small cap space, how do you approach risk management for your portfolio construction?
It's a really good question. And so I was doing this for 20 years. I had a lot of more hair 20 years ago than I do today, going through the GFC, going through the COVID crash. Small caps generally are more volatile, tend to get hit a lot harder than the general market. So general risk management techniques that we use here at 51 Capital, we do flex our cash around. In our first 5 years, we've averaged 7% cash and sitting just over 10% today, so we've got that as a tool. The most important tool that we use, though, is the underlying liquidity of our invested companies. So we don't invest in any unlisted companies. We run our liquidity measures on a weekly basis. To give you an example, if we start liquidating the portfolio today, within 20 days, we'd be at 64% cash. So the underlying portfolio, we think, compared to a lot of our competitors, is quite liquid. It's also great to have some cash there for various things, so you can stay nimble where various ideas come up, or capital raisings or IPOs, so you can deploy capital fairly quickly. So that'd be some of the main risk management tools that we use for our fund at 8051 Capital.
Good to hear. Well, thank you so much, Chris. Just a reminder, if anyone does have any questions, please pop them through the Q&A functionality, but we might hold questions until the end. So we'll come back to you with some questions, Chris, but thank you. Moving on to OzCap, now I'd like to introduce Tim Carlton. He is the founder and portfolio manager at OzCap Asset Management. OzCap manage the X20 Australian Equities Fund, which focus on opportunities outside the top 20 listed Australian companies. Tim's going to give us a bit of a brief introduction on himself, his fund's investment approach, and again, share some insights into the reporting season. So welcome, Tim.
Thanks, Nina, and I'd like to echo Chris's comments. It's a pleasure to work with Third Link and also Australian Philanthropic. So it's been a delightful and reasonably long-term relationship with Chris now, and his support's much appreciated. So OzCap runs two funds. One fund's been around since 2012. It's a high conviction fund. And then back in late 2023, we launched a second fund, which is an X20 fund. And I guess the genesis for this fund is there are some really great companies in the Australian market, but the Australian market itself in aggregate is quite an unusual market. It's reasonably concentrated. We take the ASX 300, which is the vast majority of the market cap of listed companies. Over 60% is represented by just the top 20 companies. And when we look at those 20 companies, we see a lot of businesses that we don't think will display a lot of earnings growth on a go-forward basis. And right at the top of that list would be the banks and the big miners. And you can see there the big four banks represent 22% of the ASX 300. The big three iron ore miners represent 11%. And yet if we look at what the banks have delivered from an earnings growth perspective over the last decade, if we switch to the next slide, you'll see that we really haven't seen any material earnings growth, and we don't really see that changing on a go-forward basis. And yet at the moment, these companies collectively are trading at close to the highest multiple of earnings that we've seen over their listed life, if we show that on the next chart. So we're not particularly excited by the outlook for the big banks, and a lot of individual retail investors will own these banks in their own name, so they really don't need their active fund managers, which both Chris and I are, to double up on that exposure. So this fund excludes any stocks in the top 20 largest companies in the market, and that includes the big four banks. It also includes the big three miners. And if we go to the next slide, we're of the view that China's run of increasing steel consumption, which has been somewhat extraordinary over the last 20 years, and that's represented by the little red dots on the left-hand side of this chart, we're of the view that that has finished. And in fact, their consumption of steel looked like it peaked in 2020, which is the highest dot that you can see there, and it's been declining since. And it's interesting to note that just in the last week, they've indicated that they intend to cut steel production by 20% over the coming years. Now, that's in line with our own expectations. We think they're consuming far too much steel on a per-person basis. And so obviously that's a little bit negative for the big three iron ore miners, and all of those companies also sit inside the biggest 20 companies in the market. So we think the opportunity is really outside of that. And historically, if you look at our high conviction fund, our focus has really been on the mid-cap universe, where you've got some great businesses that we want to own for a long time because we think they'll deliver great total returns to shareholders.
Well, and that's a good segue into the next question around how do you and your team identify opportunities that sit outside this ASX 20 And what makes, why do you see this section so attractive?
Yeah, so we have a very simple investment philosophy. The longer your time horizon, the more likely your total return is going to be a function of two things and two things alone. And the two things are the dividend yield that you're getting paid today and the long-term earnings growth that you're going to see from that business over time. All of the other things that affect share prices in the short term are noise, and the noise becomes less important the longer you stretch duration. And that becomes pretty obvious when you look at some of the different indices and their performances over time. That yellow line that you're seeing on the page at the moment, that's the mid-cap 50 index. So that's the 51st largest company down to the 100th inside the Australian market. And it has comfortably outperformed all of the other major indices by quite some margin over the last 25 years. And you can actually break that down into 5-year periods and you'll see a pretty consistent trend. And the reason for that is fairly simple. If we go to the next slide, we've taken the 10-year data as one example. Over time, and a 10-year period is a reasonable stretch of time, the total return you should expect to receive in a given part of the market is just a function of the dividend yield, which is the top line here, plus the annualised earnings growth that you are seeing from that part of the market. And it explains all of the outperformance of the mid-cap sector, or the mid-cap part of the market over time. And when you think about it, it's reasonably logical. The very largest companies in the Australian market, they don't have a lot of room to continue growing organically. Take the big four banks. Their market share is already so significant that it's very difficult for them to collectively grow faster than the broader market because they are the broader market. By contrast, if you look at the mid-caps, they're often companies that are dominant in their sector. They've got great return on capital metrics. They've got real earnings. In other words, they're generating cash today. You're not punting on a business that's not a proven business. And yet they've got opportunities for organic growth. And that combination tends to lead over time to faster earnings growth than you see in the rest of the market. And as duration stretches, we think that leads to higher returns. So our pretty simple view is if we can find businesses that are dominant in their sectors and we pay sensible prices for those businesses and then we hold them for a very long period of time, the total returns that our investors receive will look after itself.
So looking back on the reporting season, how did it pan out in the mid-cap and large cap space? Was it as volatile as the small caps, or how did the mid-caps perform versus the top 20 ASX listed companies?
Yeah, well, if we look at two parts of that market, if you look at the big end, really the big end represented the trend that I was talking about, in that the big four banks collectively are actually losing share, and they're losing share to Macquarie Group. Macquarie Group has a 5.6% share of the mortgage market now, and they've got a massive competitive advantage. And it comes in two forms. The first is we think they've probably got the best technology. Certainly they've got better tech than 3 of the 4 banks. And that is really leading to efficiencies that lowers their cost of servicing the customer. The second thing is because they're a relatively recent challenger, they don't have the branch costs that the other big 4 banks have. And as a result, they're taking share on a pretty consistent basis. These charts here are from CBA in the reporting season just gone. And if you look at the chart on the right, you'll see that collectively it's pretty obvious that the big 4 banks lost share in the home loan market. And they're losing it to Macquarie. And we expect Macquarie will probably double their market share in this part of the market over the next decade, which means collectively actually their share of the market is shrinking, which makes it very, very difficult to grow earnings. By contrast, if we look at the mid-cap part of the market, we think the current environment, as Chris mentioned, is relatively difficult. We're still cycling quite elevated costs in large parts of the businesses. But what you really saw there is the outperformance of the leading players in the market. So if we take 2 examples in the retail space, automotive has been a really difficult sector in the last 12 months. Obviously, higher interest rates mean less people willing to buy cars, but it also materially increases their floor finance costs and the amount of inventory that they hold. And yet Eagers delivered a much, much better result comparative to the other companies that are listed in the space. And again, it's a function of the fact that they're 11% of the market. They're nearly 5 times as large as the second biggest player in the space. So they have economies of scale that allow them to pull levers that the other companies can't pull. And on this chart, you'll see earnings per share and the share price for Eagers and one of their competitors, Peter Warren. Now, two things jump out from this chart. The first is it becomes very obvious that share prices follow earnings. Earnings are the real long-term driver for performance for any company. And you'll also see that the earnings for Eagers have held up a lot better than Peter Warren and actually all of the other players in that space. So the dominant franchise performance really shone, and it often does when times are difficult. If we give you another example, if we look at Nick Scali, which is on the next slide, and compare it to one of its smaller peers, Adairs, again, you'll see the earnings, which is the orange line for Scali's, has held up a whole lot better than the earnings from Adairs. And that's despite the fact that they've made an acquisition in the UK that is currently costing them money. So it's actually detracting from that orange line. So we expect that will become a contributor in the next couple of years. But even with that source of detraction, you've still seen their earnings performance be much stronger compared to their major peers. And again, it comes from being the most efficient and largest scale operator in the space.
So when you're looking at in the area, what are there any particular companies or sectors that you believe present a compelling opportunity right now?
Well, we don't spend a huge amount of time thinking about things from a top-down basis, but we sometimes can have observations. And one of our observations, if you turn to the next slide, is the fact that the healthcare stocks have really been under the pump for the last 5 years. In fact, a lot of them are lower than where they were 5 years ago. And that's somewhat unusual. And it's unusual because collectively, the sector has actually grown earnings 50% in that period. And the reason for this is the fact that healthcare companies became very, very expensive through 2020 and 2021. And it is important the price you pay for an asset. And if you overpay, it's going to affect certainly your near-term returns. Well, actually, most of that excessive valuation has now unwound. And you've seen it because the forward price to earnings multiple for these companies has dropped. And there are some really interesting opportunities that we're seeing. And one of those opportunities is in Sonic Healthcare. If we look at the next slide, Sonic's had a very unusual COVID experience. They were called on by the federal government to do a lot of the testing around COVID, and that led to a period of supernormal profits in 2021 and 2022. Now, to achieve those super profits, they had to hire a lot of people. They had to hire thousands of people, both in Australia and around the world. They're one of the global leaders in the pathology space. And healthcare companies do not like to make staff that they've hired and trained redundant. So as those revenues rolled off, we saw the impact on earnings from probably carrying around 2,000 staff too many across their global operations. What they've done is they've allowed natural attrition to take its course. So as people resign or retire, they don't replace those people. And so we're now at the point where we think that the negative cost effect from hiring a couple of thousand extra staff is starting to dissipate. On the other side of the coin, at first they used those wonderful earnings out of COVID to pay down debt. But in the last couple of years, they've made some acquisitions. And those acquisitions at the time of acquisition weren't making much money. In fact, some of them were loss-making. Well, they're very quickly turning those businesses around, and we expect them to be strong contributors to earnings on a go-forward basis. So what we expect from this point is that you'll see some very, very strong earnings growth over the next couple of years. And we don't think that's reflected in a multiple that, like the rest of the healthcare sector, has come back from where it was when everyone was in love with a lot of the healthcare names back in 2020 and 2021.
Oh, that was a good summary. So just to finish off, where do you see some risks or challenges in the market for the rest of the year?
I guess we're a little bit cautious on the overall environment, and we're cautious for a few reasons, and we don't like to ever make predictions. That's a folly, but we do spend quite a lot of time making observations. And one observation I'd make at the moment, if we go to the next slide, is that we're not convinced that inflation is under control. And if we compare the current episode to the episode where we got inflation that was extremely elevated in the 1970s and 1980s, We're at an interesting point in terms of it being a somewhat parallel experience. So we had the initial bout. It looks like we've got the bout under control, but all of a sudden a few narratives have taken hold. And obviously one is protectionism. You're seeing that with tariffs being put in place all around the world. That is definitionally inflationary. But probably the second narrative, which concerns us a little bit more, is that we need to be in some sort of hurry to reduce interest rates. And that's a very strange phenomenon. If you'd been off to Mars for 10 years and you came back and I told you that currently we have close to record low unemployment around the world, we've got participation rates that have never been higher. Australia just printed a record last month. We've got governments that are actually running big fiscal deficits. In other words, they're stimulating the economy. If you looked at that setup, you wouldn't necessarily conclude that we are in an environment where, central banks were rushing to reduce rates. And we think that that carries some risk. So, there's been cost inflation, there are pressures in the economy, but in the aggregate, economic growth is quite strong. We're seeing unemployment quite strong, and we're seeing a lot of stimulus still in the market. So that's not a recipe that we would normally expect to see such consensus talk around interest rate cuts. And the problem with that is that often when there is a consensus view, people have positioned themselves in accordance with that consensus view. So at the moment, in a lot of different markets, certainly in pockets of the markets, stocks look quite expensive to us, and yet there are risks that we don't think are being factored in. So we're very, very comfortable with how our portfolio is positioned, but at the same time, as things have become a little expensive over the last couple of years, we've taken the opportunity to trim, and so we're sitting with more cash than we would normally hold, and we're quite comfortable with that because we ultimately think that there will be opportunities stemming from volatility if what happens going forward isn't in line with the market's expectations.
Great, thank you so much for that great update in that sector. So now we're going to move on to some audience Q&A. So we have had a few come through, but if you did have a question that you'd like one of our portfolio managers or for Chris to answer, please send them through. To get us started though, we have one on small caps. I'll direct this to you, Chris Stott. So given the current market conditions, do you see more opportunities in growth stocks or value stocks?
Thanks, Nina. Thanks for the question. In terms of how we run the money at 1851, we're fairly style agnostic. We've got a mix of growth and value companies in the portfolio. We're seeing opportunities across both baskets right now. Taking a step back, when you look at the performance of the small cap index over the last 5 years, it's been quite poor, delivering a return of only 4% per annum. When you look back for 30 years prior to that, you saw a return of 10% per annum. So it's been a really poor period for small caps. We're more positively disposed to the outlook going forward, and the loosening interest rate cycle underway will drive earnings growth. And to Tim's point, you've seen the earnings growth in the mid-cap space drive a lot of share price growth for that sector in the last 5 or 6 years in particular. And so we believe we're entering into that phase now where earnings are going to catch up and start to bring some of those elevated multiples down, as Tim also talked about, over the next couple of years. And you can see here on the chart, Nina, the performance of the small caps, or small industrials on the left versus the all ordinaries. That's at historic lows. And on the right-hand side is a comparison of the all ords compared to the small ordinaries benchmarks. You see the last 3 years, small caps have been terrible in a relative sense compared to the overall market. But I think when you look at the small cap composition, almost a quarter of the benchmarks made up of consumer discretionary companies. In our 20 years of managing money in the small cap space, you typically find that those companies will do better under a loosening interest rate environment. So we have started with the first rate cut here in Australia more recently, with more likely to come over the next little while. So that bodes well for the small cap space, and should see, we think, growth stocks in particular outperform going forward.
Good answer, thank you. Tim, we've got one for you. So we've got one that's more around what sort of returns are we expecting from Australian equities in 2025, and how much will be capital gains versus how much will be income?
Well, it's a good question. I'm sure we'd all love to know the answer to that one ahead of time. Listen, we can't predict these things. I guess what I would say is don't try to predict these things. What I am very confident in saying is that over our lifetimes, investing in Australian equities will be a very fruitful endeavour. Australia as a country is in a very unusual and fortunate position. We've got strong population growth. We've got a stable system of government. We're very proximate to 3 billion people that are emerging from poverty. We've got a huge resource land bank. We've got private property ownership, rule of law. All of these things really matter to business creation and the generation of long-term returns. So over the last 100 years, the Australian stock market's done 11 to 12%, which has been the best performance of any developed market globally. And really, if anything, we see the case for Australia strengthening on a go-forward basis. So there may be hiccups, there may be periods where resources are weak or where the banks are struggling, but in the long run, there will be plenty of opportunities for companies that are based in Australia to deliver great returns for investors.
Okay, so how do you see global markets or global equities going in comparison, and what difference do you think the election of the Trump administration has made to whatever your answer to the question is? So how do you think global markets are, what's their outlook for this year?
Well, I think all we're seeing at the moment is that markets got quite excited by the prospect of Trump, and now they're realising that there's probably an associated level of uncertainty around decision making, and I don't think that that's going to change. So there are some reasonably large changes that he is making to the US market. The US market is currently priced at elevated levels compared to where it has traded historically. So we're not surprised that we're seeing volatility. I think the important thing is investors don't need to be in a rush to invest unless there's an opportunity. So we think patience is a very important feature of good investing, and we do expect further volatility over the course of the next 6 to 12 months, mainly because markets are priced for perfection. So when you don't get that, then often you'll see markets react accordingly. So we're hoping that markets actually are volatile, and preferably, interestingly enough, head south, because that will give us opportunities to buy into some of Australia's great businesses at more attractive prices than we're seeing today.
Okay, so as active stock pickers, how can active managers beat index managers at a time when so much money is flowing from active to passive?
I'll have a go at that. Maybe Tim wants to throw in some comments as well. But firstly, I'd call out, the small cap space. What we have noticed in the last 10 years is the decline in quantity and quality of sell-side broker research. The small cap space has always been under research, but I'd say it's probably the most under researched I've ever seen it in terms of the attention that some companies get paid, particularly sub $500 million of market cap. So the opportunity to beat an index, I think, is if you have the right process and you obviously select the right companies, is as good as ever. I think, though, that trend of passive growth money will continue, not only here domestically but globally. But for managers, I mean, we see ourselves as one of our key differentiating factors is that we limit the size of the fund. Most fund managers come out of the gates, deliver really strong performance in the first few years, scoop up funds under management, typically grow to a size where they become too big and that erodes returns over time. So we think by limiting the size of the fund, that gives ourselves the best possible chance to deliver strong returns net of all fees and expenses over the longer term.
What's your capacity, Chris?
We're at capacity now, so we're just over $500 million. We're going through the process now where if we continue to see growth in the fund to say north of $600 million, we'd start to consider other capital management options, albeit restricting people's ability to reinvest distributions or even returns of capital over time. And we'll keep recycling capital to make sure that we're staying in an appropriate size for the fund where we think we can deliver the type of returns that we have in our first 5 years.
Great. So I've had another question around banking stocks. So where there's a lot of press and consensus view is that the banking stocks are overvalued, but their share prices keep increasing. Tim, this might be one for you, but why is this the case and who's buying it? Who's buying these shares?
That's a very good question. Listen, I think quite often as investors, we fall into the trap of worrying about what's happening on a 6 to 12 month time horizon. The market will ultimately be rational. It might not be rational over short durations because it's a function of a whole lot of different investors that have different time horizons and different focuses at different points in time. If we come back to it's a little similar to the passive versus active debate. If you think about a market that's great for passive investing, it's where your biggest companies are growing their earnings really quickly. Because in that environment, if you're in a passive ETF, you're naturally most overweight the largest companies. You think about the worst environment over any sort of reasonable stretch of period, which we would say is at least 5 and preferably 10 years. And you don't want to be in a passive ETF if the market at the top end is chock full of companies that will struggle to grow their earnings. And we would put the Australian market in that second camp. So I tend to think that the next decade is going to be fantastic for active stock picking. I think that's where you're going to want to be. And I think it's logical if you just think about the earnings growth that you're likely to see from different parts of the market. So if you've got skilled stock pickers that can pick great mid caps that deliver a lot of earnings growth or great small or micro caps that deliver a lot of earnings growth, they are going to outperform an index that overall is quite heavy with stocks where we think they're really going to struggle to grow earnings at all. And that might not be reflected in any 6 or 12 month time horizon, but I do think it will get reflected, in any 5 to 10 year time horizon. And I'm reminded of the old adage, over the short run, the market is a voting machine, but over the long run, it's a weighing machine, and what's being weighed is earnings.
Good summary. I'm about to hand over back to Chris Cuffe to do a final wrap up, but I just wanted to thank you all for joining us, and thank you to Chris and Tim for joining us today, two of our fantastic underlying managers who obviously, if you want exposure to small caps, so it's the 1851 Emerging Companies Fund and the AusCap X20s Fund. So you won't get exposure to the banks, but we'll get some good active stock management. So thank you very much for joining. Chris, I'm going to hand over to you to wrap us up.
Yes, thanks, Nina, and thanks to Chris and Tim very much. So that's the example of 2 of the 12 managers in our fund, and I'd like to think the other 10 managers are pretty high quality too, and they all have a uniqueness about them. But look, just back to the fund I run again, Third Link Growth Fund. My job is not to pick stocks. My job is to pick fund managers. So I spend my existence doing that. I look for active managers. I look for owners. So, both Chris and Tim, major owners of their firm, means they've got a big skin in the game. I look for managers who would probably, like on their tombstone, written that they were great investors as opposed to great gatherers of funds, which unfortunately a lot of our industry is. But in Third Link too, it's a one-stop shop. You've got access to exposure to a dozen managers through a single investment. That investment can be as small as $20,000, and as we've seen here, some of those managers you can't get into yourself. Chris's fund's closed. Other funds might be wholesale in nature that some can't get into. So it's a one-stop shop. You get one statement, which saves a whole lot of paperwork, and again, the icing on the cake is it's a pretty feel-good thing that you're helping the charitable sector at the same time. So I commend that fund to you, and hopefully to people if it suits their circumstances. Thank you for attending.
So, and if you did want any more information, please visit www.thirdlink.com.au, or feel free to reach out to me directly and I can help you. My email address is nina, Nina, @thirdlink.com.au. Thanks again, and we look forward to staying in touch.